ओके सो ये चैप्टर ओवरव्यू ऑफ फिक्स्ड इनकम पोर्टफोलियो मैनेजमेंट दो पार्ट्स पे डिवाइडेड है. पार्ट वन में इट इज़ एक्चुअली दिस चैप्टर ओवरव्यू एंड पार्ट टू में अननेसेसरली दे हैव गॉन इनटू द सेकंड चैप्टर विच इज़ लायबिलिटी ड्रिवन इन्वेस्टिंग पैसिव मैनेजमेंट के अंदर चले गए. मेरे ख्याल से देयर वाज नो नीड टू इंट्रोड्यूस पार्ट टू ओवर हियर. वो उसी चैप्टर में छोड़ना चाहिए था जैसा 2024 तक था. एनीवेज, सो पार्ट वन में the first discussion, section 1, is on what is the role of fixed income in an overall portfolio. Because overall portfolio में तो traditionally equity होगा, fixed income होगा, alternate investment होगा. तो fixed income का क्या रोल है? So they are saying that fixed income जो है that is required for the purpose of diversification because का correlation equity के साथ low है. Of course when I say correlation low है, बहुत सारा type of fixed income securities है. फिक्स्ड कूपन, फ्लोटिंग, इन्फ्लेशन लिंक्ड. सो इन दैट केस सबका अलग अलग कोरिलेशन है इक्विटी के साथ, बट कोरिलेशन यूजुअली लो है. ऑफ कोर्स ये कोरिलेशन डिफर करता है ड्यूरिंग डिफरेंट टाइम पीरियड्स. लाइक क्राइसिस के टाइम पे ऑब्वियसली इक्विटी के बीच में और से हाई यील्ड फिक्स्ड इनकम सिक्योरिटीज़ में कोरिलेशन हाई हो जाता है, बट इक्विटी के बीच में और ट्रेजरी के बीच में कोरिलेशन क्या हो जाता है? लो. यू कैन अंडरस्टैंड द रीज़न वाई. सेकेंड रोल ऑफ फिक्स्ड इनकम जो है दैट इज़ दैट रेगुलर कैश फ्लो. फिक्स्ड इनकम प्रोवाइड्स रेगुलर कैश फ्लो. इक्विटी में तो यू कैन नॉट डिपेंड ऑन इट फॉर रेगुलर डिविडेंड्स ना. इट डिपेंड्स वेदर कंपनी विल डू इट और नॉट, या बाईबैक करेगा या नहीं करेगा. बट फिक्स्ड इनकम कुड बी रिलाइड फॉर रेगुलर कैश फ्लो. ऑफ कोर्स व्हेन आई से सो इट इज़ मोर सो फॉर फिक्स्ड कूपन बॉन्ड्स rather than फ्लोटिंग रेट बॉन्ड्स. तो रेगुलर कैश फ्लो जिनका लायबिलिटीज़ है, ओके, जिनको इतना पैसा चाहिएगा 3 साल बाद, 4 साल बाद, 5 साल बाद, तो फिक्स्ड इनकम का पोर्टफोलियो बनाने से वो बेटर अचीव हो सकता है. एंड फाइनली फिक्स्ड इनकम का जो थर्ड रोल है वो ये है, इट एक्ट्स एज अ हेज अगेंस्ट इन्फ्लेशन. नाउ दिस इज नॉट ट्रू ऑफ ऑल द फिक्स्ड इनकम सिक्योरिटीज. फॉर एग्जांपल जो टिपिकल फिक्स्ड रेट बॉन्ड्स होता है, दे आर द वर्स्ट हेज अगेंस्ट इन्फ्लेशन बिकॉज ऑफ इन्फ्लेशन गोज अप, ऑब्वियसली इंटरेस्ट रेट गोज अप एंड द फिक्स्ड कूपन बॉन्ड प्राइसेस फॉल. सो व्हेन दे आर टॉकिंग अबाउट हेज अगेंस्ट इन्फ्लेशन, दे आर टॉकिंग अबाउट टू टाइप्स ऑफ सिक्योरिटीज. नंबर वन, फ्लोटिंग रेट सिक्योरिटीज जिनमें द मार्केट रेफरेंस रेट इज इंक्रीज, व्हेन इट इंक्रीजेस देन द कूपन रेट इज इंक्रीज्ड. सो अकॉर्डिंगली कूपन इन्फ्लेशन का जो प्रोटेक्शन है, कूपन का जो इन्फ्लेशन प्रोटेक्शन है, दैट इज प्रोवाइडेड बाय फ्लोटिंग रेट नोट्स. बट इफ यू टॉक अबाउट इन्फ्लेशन प्रोटेक्टेड सिक्योरिटी, टिप्स वगैरह, तो दे प्रोवाइड प्रोटेक्शन फॉर बोथ कूपन एज वेल एज प्रिंसिपल, बिकॉज यू नो दैट उस पर वो प्रिंसिपल एडजस्ट होता है अकॉर्डिंग टू कंज्यूमर प्राइस इंडेक्स और उसके बाद जाके कूपन मिलता है. तो अकॉर्डिंगली कूपन प्लस प्रिंसिपल प्रोटेक्शन इन द केस ऑफ इन्फ्लेशन लिंक्ड सिक्योरिटीज. So that's the role of fixed income in a overall portfolio. Now, next part goes into the fact that how many types of mandates are there. When you are managing a fixed income portfolio, you are the manager. What's your mandate? Target kya hai? So there are two types of mandate. One is your liability related mandate, liability based mandate, and the other is your इंडेक्स बेस्ड और टोटल रिटर्न मैंडेट. तो लायबिलिटी बेस्ड मैंडेट जो है उसमें वी हैव अ स्ट्रीम ऑफ लायबिलिटीज. बेस्ट एग्जांपल इज यू कैन पिक्चराइज अ पेंशन डिफाइंड बेनिफिट पेंशन प्लान जिसको इतना अमाउंट पे करना है, ठीक है. और यू कैन पिक्चराइज अ लाइफ इंश्योरेंस कंपनी जिसने पॉलिसीज लिखा है और इतना अमाउंट है. या यू कैन पिक्चराइज अ रिटेल माने एन इंडिविजुअल, प्राइवेट वेल्थ इंडिविजुअल हु हैज़ टू सेंड हिज सन और डॉटर फॉर एजुकेशन और इतना पे करना है 20 साल बाद, 18 साल बाद. ओके, सो वॉट एवर इट इज़, व्हेन यू हैव और रिटायरमेंट के लिए आपको इतना चाहिएगा. सो व्हेन यू हैव अ स्ट्रीम ऑफ लायबिलिटीज विच मे बी सर्टन, अनसर्टन, वॉट एवर, यू कैन डिजाइन अ फिक्स्ड इनकम पोर्टफोलियो टू मीट द लायबिलिटीज. डिजाइन अ फिक्स्ड इनकम पोर्टफोलियो to immunize the liability. Immunize means interest rate बढ़े या गिरे, we should be able to meet the liabilities. उसका 4 methods है. Okay, one method is cash flow matching. The other method is duration matching. The third method is contingent immunization and the fourth method is derivative overlay. Cash flow matching में जैसा नाम दिख रहा है, we try to match the liabilities with the cash flow from the bond portfolio. अगर मेरा liability 2 साल बाद 10 million का है तो I would like to have a portfolio which generates 10 million after 2 years. अगर मेरा liability 3 years के बाद 40 million का है, I would like to generate a portfolio which generates 40 million after 3 years. So that way my liability shall be immunized whether interest rate goes up or goes down. Of course we will discuss details about it. Many times कैश फ्लो मैचिंग हो नहीं पाता है, there's a dearth of such bonds which can exactly immunize, okay, या फिर the yields on such bonds are very low, so therefore we go for duration matching. यानी कि जो अपना liabilities है उनका duration क्या है, duration मतलब उनका sensitivity क्या है with respect to interest rate. So we try to create a bond portfolio जिसका sensitivity with respect to interest rate is the same, so that अगर interest rate change हुआ तो liability जितना उछलेगा या गिरेगा उतना ही asset उछलेगा गिरेगा. Accordingly we shall be immunized. DA equal to DL. There is more to it, okay, which we shall discuss primarily in the next chapter, not in this chapter. Although cash flow immunization part 2 के अंदर यहाँ discussed है. Then we have derivatives overlay. You must be understanding that T-bond futures or interest rate swap, okay, they can be used for the purpose of fixed income portfolio management, because every time you can't use bonds for the purpose of liability, you have to use these derivatives for the purpose of liquidity. We'll come to the liquidity discussion also in this chapter. And finally, contingent immunization says that why are we being so conservative कि केवल liabilities को meet करना है. अगर अपने को ऐसा दिख रहा है कि अपना assets they have exceeded the liabilities by a substantial amount, then we can play now. We can take some risk and we can try to increase the return from the portfolio. So contingent immunization is that only कि when your PV of the assets exceed the PV of the liability by a certain threshold, you can go for active management. Okay, take some risk. But when that threshold is breached, okay, then you shift to passive management. Okay, on the right hand side, which means as far as total return mandate is concerned, it's index based, as in there is a fixed income index. Okay, Barclays index is popularly being written in the core, and that index consists of say thousands of bonds, and those bonds obviously getting redeemed, getting called, changing, they are paying coupons and so on and so forth, their duration is changing. So we have to construct a portfolio either to meet the benchmark or to beat the benchmark, to meet the benchmark or beat the benchmark. Obviously you understood, if we have to meet the benchmark, exactly portfolio को replicate करना है, that's pure indexing. More or less we buy all the bonds which are there in the portfolio in the same proportion, or we do some sampling, we'll talk about it, or we do enhanced indexing, in which ये usually sampling में होता है, we try to maintain the duration of our portfolio equal to that of the benchmark. Also we try to ensure that the other risk factors like the percentage invested in high yield, the percentage invested in treasury, okay, the quality thing, the credit spread thing, the diversification, we try to ensure that the other risk factors are also more or less matched with the benchmark, but not exactly equal to benchmark. There are minor mismatches. Why? In order to beat the benchmark, at least to cover the transaction cost, because otherwise in pure indexing, our return shall always be less than the benchmark because of transaction cost, although tracking error would be very low in the case of pure indexing. Enhanced indexing mein tracking error would be higher than pure indexing, but then our price is to get a return which is better than pure indexing, which is equal to the benchmark or just higher than the benchmark, okay, by some minor mismatches. And finally the last part, which is pure active management, in which we really take a call on interest rate. मेरे को लगता है interest rate गिरेगा, I try to maintain a portfolio duration more than the benchmark. Okay, मेरे को लगता है yield volatility is going to rise, I maintain a convexity of my portfolio more than the benchmark. Okay, मेरे को लगता है कि good days are going to come, so I try to expose myself more to the high yield bond. Okay, और मेरे को लगता है bad days are going to come, I shift my portfolio more towards the treasury as compared to benchmark में जितना treasury है. So all those plays will be done in active management, जिसका दो चैप्टर है. Okay, yield के डायरेक्शन में और क्रेडिट के डायरेक्शन में. So that was the second part of the chapter. The third part of the chapter, the third part 3, is about discussion on risk measures in fixed income portfolio management. Obviously, as soon as you think about the fixed income area from level 1 level 2, क्या याद आता है? Duration, convexity. और duration में Macaulay duration, modified duration, effective duration, convexity में normal convexity, effective convexity. Then we remember dollar duration, we remember PVBP, price value of a basis point. Okay, we remember spread duration. Okay, and then there's a talk about dispersion also in this chapter. Okay, and stuff like that. So basically ये सारे का revision किया है इसमें. तो इसमें मेरे को जो main बोलना है वो ये है कि you know, like if I were to speak about the main points, when we are talking about sensitivity of the portfolio with respect to interest rate. So if the portfolio consists of bonds which are option embedded, so obviously we have to use effective duration, effective convexity, because जो modified duration and convexity है वो तो ये assume करता है कि when interest rate will change, the cash flows from the bond will not change, only the present value will change. But in case we have obviously option embedded bonds, then the cash flows will also change, na? Callable, puttable and all that. We should use ED and EC. Okay, you also know that we should use KRD when we key rate duration if we feel that the yield curve will shift non-parallelly. So KRD need to be seen. Also, if we feel that the yields will shift substantially, convexity needs to be considered along with duration as a supplemental tool. We people talk also about price value of a basis point, like 1 basis point अगर interest rate change हुआ, so in that case what would be the change in the dollar value of the portfolio? Okay, there's a talk about spread duration. If the spread changes by 1%, what will happen to the value of the portfolio? There's a talk about empirical duration. That's very important. Empirical duration, they've said that जो typical अपने duration निकालते हैं, that assumes that, say for example ED of a bond portfolio is 7. That means if the benchmark yield changes by 1%, the benchmark curve changes by 1%, then the portfolio will change by 7%. But when the benchmark curve will change, then the spread will also change. When the benchmark curve will change, the spread will also change. Usually they move in the opposite direction because the benchmark yield is pro-cyclical, but the spreads are counter-cyclical. I hope you're understanding. If the economy is going to do well, economy does well, it's overheated, interest rates are increased by the central bank. So the benchmark yield is pro-cyclical. But at the same time, when the economy does well, the spreads contract. So accordingly, it's counter-cyclical. So because of which you can't assume, especially in the case of high yield bond, that effective duration will do a good job. It will not do a good job. It will overstate the sensitivity of the portfolio. You should use empirical duration, especially in the case of high yield bond, where spread component of the total YTM is a significant component. Okay. Then there's a talk about dispersion. Dispersion is basically the variance of the time of the various time that we are receiving cash flows in the bond portfolio compared to the duration of the bond portfolio. So the duration of the bond portfolio is at 3.5. So if you are receiving money at 1, 2, 3, 4, 5, 6, it's like 1 minus 3.5, the whole square weighted by the cash flow that way. We don't have to go into the calculation of dispersion, but you should know that there's a measure called dispersion. Now the reason why dispersion is given is because dispersion is connected to convexity. Higher the convexity, higher the dispersion. That's the way it happens. Now the point is that dispersion is an important variable to monitor in the case of liability driven investing, because if you are keeping a bond portfolio for the purpose of immunizing the liability, which is a high dispersion, maybe there will be a structural risk in doing so, which means that if there is a non-parallel shift, you will find that your portfolio may not be able to meet the liabilities. Okay, so we will discuss that in the next chapter. For this purpose, understand that there's something called dispersion which deals with structural risk. Okay, so this is the portion given in the risk section. The fourth section of the chapter moves into the return. As far as the return part is concerned, let's understand that the return of a bond portfolio is often talked in terms of YTM, but you know from level 1 YTM has its own illogical, unrealistic assumptions of reinvestment and of the fact that we hold the bond till maturity and the fact that all the cash flows are received on time as scheduled. So because of which YTM is not preferred. Instead, we have the expected return framework. कि अगर आप portfolio manager हो, तो you should take a choice about anything. Like मैं कोई और bond include करूँ कि अपने portfolio में, by looking at the expected return that will happen. Now, the expected return has a number of components. The first component is obviously the coupon component. You will receive coupon, okay, and obviously the reinvestment income also. So it's basically the current yield plus reinvestment is the coupon component. In most of the questions, reinvestment rate is not given, so because of which basically the coupon component is the current yield. The second part of the exercise is the expected price change in the bond if the yield curve remains unchanged, the roll down return. Okay, if the yield curve remains unchanged and 1 year passes by, 1 year I'm taking this example, maybe 6 months passes by, so what will happen to the price of the bond? The percentage change in the price. Okay, usually you can take the feeling of pull to par, that for a discount bond the price will rise, for a premium bond the price will fall, but then the talk is not about the YTM will remain the same, the talk is about the yield curve will remain the same. Okay, anyways, the sum total of the coupon effect plus the roll down return is called the rolling yield. It's called the rolling yield. Next component in the expected return framework is the expected price change on account of your view about how the benchmark yield is going to change, because the benchmark yield will change, it will have the duration and the convexity effect. Correct? The fourth component is about the expected change in bond price as a result of the spread changes. If the spread changes, then what effect it will have on the value of the bond portfolio using once again the spread duration and the spread convexity. And finally we have the expected price change because of change in the currency, because if our portfolio has foreign bonds, obviously currency factor comes into play. We wish that the foreign currency appreciates, but it can depreciate to whatever the percentage change in the currency. Please understand that this model, expected return framework, is an approximate model. It ignores the local considerations, the fact that locally the market may be cheap or rich, or there could be other regulations that is being ignored over here. So this is an approximate model which does the job. Every fixed income portfolio manager generally uses this framework when deciding upon how to shift and twist the portfolio. Okay, so this is the expected return framework. Next, we move into other considerations. In other considerations, we have three considerations: discussion about leverage, discussion about liquidity, discussion about taxes. Let's discuss them one by one. As far as leverage is concerned, we know that leverage amplifies the financial consequences, and you can utilize leverage as a bond portfolio manager by either borrowing funds or by using derivatives. By borrowing funds or by using derivatives. When I say borrowing funds, obviously you understand you can do repo. You have some security, you keep it as a collateral, as in sell the security and then contract to repurchase it back. So the funds that you get in between, that can be used for the purpose of fixed income portfolio management. Okay, of course, securities lending or borrowing is separately given apart from repo, which means that in the case of repo, it is done for a fixed term, say for 10 days, 5 days, 7 days. But when we are doing securities lending, borrowing, in that case, the other party can come and take back the money or call back the money whenever he wants. So there's a greater risk in securities lending as compared to repo. Okay, so these are the various ways in which you can use leverage. Whenever you use leverage, in that case, what will be your return with leverage as compared to without leverage? That depends upon your return on invested funds. Is it greater than the interest rate of borrowing or less than? So if your return on invested fund is greater than the cost of borrowing, obviously leverage is good. But if your return on invested fund is less than the cost of borrowing, leverage is going to hurt. The formula in this regard is return on leverage, RL, is equal to return on invested fund, say RI, plus bracket RI minus cost of borrowing, the whole into debt equity ratio. Okay, this in the normal classes I have done it by intuition. Over here I spoke it via formula. So that is leverage. The next discussion is about liquidity. We know that the fixed income market is less liquid as compared to equity market, primarily because the fixed income market is over the counter. There's a search cost involved. There's a lack of transparency in the fixed income market. But when we say the fixed income market is less liquid, this general statement cannot be applied to all categories of fixed income. It depends upon whether we are talking about treasury securities or investment grade or high yield securities. Obviously, treasury is most liquid, investment grade is less liquid than treasury, and the high yield is least liquid as compared to treasury. This is regarding the credit quality. Talk about complexity. If there's a more complex bond, okay, say a structured financial note where a bond is there together with embedded option, in that case obviously ABS, MBS and all that, these are less liquid because they are complicated. Liquidity also depends upon whether we are talking on the run or off the run. On the run is more liquid than off the run. Okay, liquidity also depends upon the issue size. If issue size is big, obviously liquidity is what higher. So these factors should be known when you as a fund manager are entering the bond market, because you'll ultimately have to manage the portfolio, and if the portfolio has constituents which are illiquid, you may ultimately have to use some other instruments for the purpose of trade, as in mutual funds, ETF, you know the differences. You can use derivatives as in T-bond futures, or you can use total return swap. I hope you know total return swap. It is swap in which the total return of a bond is passed on by one party in return for some floating or fixed coupon. Okay, that's a total return swap. One can use CDS for the credit risk. Total return swap tackles both the credit risk and the market risk. And finally, the last consideration in that other consideration was taxes. We should understand that everybody is concerned with the after-tax return of the portfolio, not the pre-tax return, except if we are talking about tax-exempt investors like foundations. Because in case we are talking about tax-exempt investors, they will take decisions purely based upon the investment view. For example, if I am a foundation and I am having a $500 million fixed income portfolio and I need some liquidity, say $5 million, and I need to sell, say, bond A or bond B for the purpose of generating $5 million, then I will obviously sell that particular bond which is right now overvalued, Okay, maybe it has a capital gain. The other bond B is slightly undervalued, but it is a capital loss. But I am not concerned with tax loss harvesting because I am an exempt individual or exempt investor. But if we are talking about a taxable investor, an ultra HNI client. Obviously, even though bond A is slightly overvalued and by investment opinion that should be sold, but since it has a capital gain, I may not sell bond A, I may sell bond B, which is slightly undervalued, but it has a capital loss, and therefore it will allow for tax loss harvesting. Okay, so taxation issue should be considered, but taxation issue is in depth covered in the private wealth management section. So I think it is something that should be done over there. Over here, we should have a feel of the same. Of course, we should also know the common sense that interest income in most countries is taxed at a higher rate as compared to capital gains. And in capital gains, long term is taxed concessionally as compared to short term. So any portfolio manager would wish that for a taxable client, capital gains component is higher than the coupon income, and in the capital gains component, long term capital gains is higher than the short term capital gains. Okay, of course, international taxation also comes into picture because in different regimes there would be different rules around the same. So that covers our part 1, which was all about overview of fixed income portfolio management, and we move into part 2. When we talk about part 2, in part 2 they've gone into LDI. When they went into LDI, they explained that basically we are talking about asset liability management. So asset liability management essentially means that the nature of your assets and liabilities should be same. The sensitivity, say the market risk, the sensitivity of your assets and liability should be same. So that when there's a change in your asset, there is an equal change in the liability, and your equity, which is the residue, is not exposed to too much of risk. That's asset liability management. Now within asset liability management, if the structure is such that your liabilities are given, so you have to manage the assets in such a manner that they match with the liabilities. That's called LDI, liability driven investing, about which we are interested. On the other hand, if you talk about ADL, asset driven liability, that is like your assets are given, the assets are arising out of business decision, and your liabilities have to be taken in such a manner that they match with the assets. That's done in corporate finance, in normal level 2 stuff. And there could be asset liability management on the whole, where your assets and liabilities are both in a state of flux, occurring on account of business decision. They are partly business decision and partly you will manage them in order to match the assets and liabilities. Anyways, the focus is on liability driven investing. Then in the liability driven investing, they are requesting us to imagine multiple liabilities, which is strange because they should have explained the single liability framework first, but that is in the next chapter. Okay, that's the dilemma. And over here they've explained multiple liabilities. Suppose we have a liability after 2 years, 3 years, 4 years, 5 years. What do we do? How do we construct a fixed income portfolio so that these liabilities are exactly immunized irrespective of change in interest rate? The best method is cash flow matching. Construct a portfolio of coupon bearing bonds or zero coupon bonds which exactly generates the liability amount in year 2, year 3, year 4, year 5. They've given an example to explain how it is done. For example, if you have a portfolio of coupon bearing bonds, then that portfolio, the last liability, say 5th year liability, has to be met by the 5-year bonds face value and the coupon amount. So we have to divide the liability of the 5th year by 1 plus the coupon rate of the 5th bond, and we get the face value for the 5th bond. Okay, then obviously we come to the 4th year, and from the 4th year we deduct the coupon of the 5th year, and then the net amount we divide by 1 plus coupon rate of the 4th year bond, and we get the face value of the 4-year bond. If somebody is not understanding, then please understand this is just a summary. It presumes that you have knowledge about it and you are listening to me because you have done the same and you want a faster revision. You can't judge me. Oh, this is the way sir explains. Then it is stupidity and naive, especially at level 3. So this is an example of contingent immunization which is given, which everybody should study. And then there's a talk about ladder portfolio. Okay, we must have we must be remembering that there were 3 main maturity based strategy or maturity based portfolios. One was bullet, the other was barbell, the third is ladder. So the bullet is the one where you concentrate your fixed income into a particular maturity, say 5 years, and in the barbell you go for concentrated amount in the short term and the long term, say the 2-year and the 10-year, and in the ladder you diversify yourself across the maturity spectrum: 2-year, 3-year, 4-year, 5-year, 6-year, 7-year, 8-year, 9-year, 10-year. So it is said that the ladder is so spread away, so diversified that it ensures that you have less of a problem if there is a twist or a reshaping of the yield curve, because you are spread across the spectrum. Plus, every time there is a soon to mature bond, such that you do not have any liquidity risk whatsoever, and plus you are able to invest the money into long-term bonds, so you are able to enjoy the higher convexity also, while at the same time enjoying higher liquidity. So they really preferred the laddered bond. Anyways, if we talk about convexity, you know that higher convexity is always a desirable property, because higher convexity means if the yield falls, your bond portfolio will rise more. If the yield rises, your bond portfolio will fall less. But this higher convexity comes at the cost of lower yield, because you have to pay more for bonds with higher convexity. Now the point is that the convexity is a function of dispersion, as I said. So the highest convexity is there in the case of barbell, and the lowest convexity is there in the case of bullet. And obviously the ladder portfolio has a convexity or dispersion which lies in between the barbell and the bullet. So we'll talk about structural risk in this regard in the next chapter when we revisit this stuff. So that's the talk about ladder portfolio that they have undertaken over here.